If you're like many business owners out there, you have a loan with your bank. And many of those loans are ABL loans or asset based loans, in which case the bank is giving you a percentage of those quick assets, either inventory or accounts receivable, to provide support for the loan that they're giving you. Well, depending on the situation, either in your company or at the bank may change those advance rates and therefore provide more assets to support the loan that they're giving you. Well, that can create a problem for you because it certainly affects the amount of money that you're able to borrow. But the big question is first, why are they changing those advance rates? If it's because they're concerned about the value of your accounts receivable, or if they're concerned about the value of the inventory you're holding, that's something that you can negotiate with them and talk about. If they're changing the advance rates because they want you to leave the bank, that creates a different situation because you may be facing what many banks call bank fatigue with regard to your loan. Maybe your financial reporting is not getting them on time. Maybe the financial reporting is inconsistent. Maybe they're at a point where they don't trust the way you're running your business and they would really rather have you with somebody else. So there's not much we can do about that without changing the relationship with the bank. But if the bank is changing your advance rates because they're concerned about the value of your inventory or concerned about your accounts receivable, there are some things that you can do to show them that there's no need to reduce those advance rates for you. So in the case of inventory, if your inventory has risen above a level that it normally has been before, what you need to do is show them that your inventory turns are increasing as well, which means that you need to have that additional inventory to support the sales. The bank's not going to be concerned if you're turning that inventory over and using it to sell. They're just concerned if the inventory level is rising without need for it because of the supporting sales for it. So showing them that you have an effective turn rate for the inventory will certainly help you. The other thing is that the inventory may be rising in value because of inflation or because of manufacturing costs from your suppliers. If you can show them that that is something that's happening in the marketplace overall, you can certainly maintain the advance rate that you've gotten. With regard to accounts receivable, one thing that banks are always concerned about is customer concentration. And if you have a heavy customer concentration with one or two or even five customers, they may tighten up that advance rate because they feel that there's too many eggs in one basket and your company is at risk because you have too much money out with one particular customer. So one thing you can do is either be in a position where you get more customers so that your accounts receivable is spread over a larger group of customers, or you can be in a position where you get credit insurance to support the money that you're providing to those customers. Either way, that's going to give the bank a feeling of greater confidence that they're going to be able to collect the money that they need from the assets that you have should something go wrong.